Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Coinbase.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock, if you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
All right, getting right into the hook for today, we have a seriously fascinating corporate mystery to unpack for you. Usually when we go through these corporate earnings, the narrative is pretty straightforward.
Right, you look at the top line, the bottom line, and you instantly get the health of the business.
Exactly. But today, the headline numbers completely spooked Wall Street. We're talking about a company that reported a loss of nearly $400 million on paper.
Which is massive.
Yeah, and they suffered a 21% drop in sequential revenue, right in the middle of a brutal 22% crash in the price of Bitcoin. But somehow, they're emerging fundamentally stronger and grabbing record market share.
It's wild. I mean, in a world of total information overload, separating that initial headline shock from the actual underlying business health is really the only way to figure out what's happening under the hood.
Because the prevailing narrative has always been that this company is just a casino, right? Just retail investors trading highly volatile tokens.
Right, but the actual data tells a story of a quiet, massive pivot toward, well, boring, predictable, recurring revenue.
All right, let's move into the wealth building context, because for you, the listener, understanding how this fits into long-term wealth creation is vital.
Oh, absolutely. If you want to build wealth with a stock like this, you have to look at how they survive the whiplash of the crypto market.
Right, and they are doing it through massive revenue diversification. Their transaction revenue, like the fees they charge when users buy and sell crypto, fell to $755.8 million in the first quarter.
Which is just a symptom of the crypto winter. People weren't trading.
Exactly. But while that was dropping, their subscription and services revenue absolutely exploded. It hit $583.5 million.
Wow.
Yeah. And that specific bucket now makes up an impressive 44% of their total net revenue.
That is a massive structural de-risking of the business. They're basically reaching a point where half their money comes from predictable services rather than, unpredictable trading volume.
It feels identical to the playbook Apple ran over the last decade.
Oh, exactly. Apple used to live and die by physical iPhone sales every quarter. Highly cyclical.
Right, so to insulate themselves, Apple built that massive services division, Apple Music, iCloud, to smooth out the slumps. And Coinbase is running that exact same strategy for financial infrastructure.
And the crown jewel of that services division is stablecoins. Stablecoin revenue specifically hit $305 million this quarter.
Which is up from $274 million year over year. The mechanism there is just brilliant.
It really is. A token like USDC stays pegged at exactly $1. It doesn't fluctuate. But to maintain that peg, every single digital USDC is backed by a real US dollar or a treasury bill sitting in a traditional bank account.
And Coinbase manages those reserves, so they just collect the interest.
Right. They are currently holding an all-time high average of $19 billion in USDC on their platform. By simply earning yield on those reserves, they are printing highly predictable cash.
It literally doesn't matter if Bitcoin is at 100,000 or 10,000. That yield generates reliable cash.
Exactly.
Now let's look at the fundamentals, because we really need to address that massive earnings miss. The raw numbers were undeniably ugly.
Oh, for sure. The GAAP net loss was a staggering $394.1 million.
Which translates to a loss of $1.49 per share. They completely missed the expectation of a 27-cent profit.
If you're just skimming push notifications, it sounds like a catastrophic disaster. But the mechanics of GAAP generally accepted accounting principles tell a totally different story.
Because GAAP rules can be super rigid. Right.
Yeah, they obscure the day-to-day reality here. A huge portion of that nearly $400 million loss isn't actual cash leaving the company. It's the result of mark-to-market accounting rules on their crypto holdings.
So basically, because Bitcoin dropped 22% during Q1, they have to write down the value of their holdings on paper.
Exactly. It registers as a hit to net income, but they didn't necessarily sell those assets to lock in a cash loss.
It's like looking at a homeowner's net worth dropping because housing prices fell in their neighborhood.
Right.
Even though their actual paycheck and savings account are perfectly fine, and they're easily paying the mortgage.
That's a great analogy, and we can see their core paycheck is robust when we look at adjusted EBITDA.
Right. Earnings before interest, taxes, depreciation, and amortization.
Exactly, which is a much more reliable proxy for actual cash generation. If you strip out those non-cash accounting distortions, their adjusted EBITDA actually remained positive at $303.3 million.
That is wild. And looking at the historical data, this is their 13th consecutive quarter of positive adjusted EBITDA.
Yeah, through massive bull market peaks and crushing bear market troughs alike.
Which leads directly into their fortress balance sheet. Because they diversified, they hoarded cash. They are sitting on over $10.2 billion in cash and equivalents.
Which is just an astronomical amount of liquidity. It's corporate Darwinism in real time. They can survive without diluting their equity.
And they're actively leveraging it to restructure. They aggressively cut adjusted expenses by 8% and recently reduced their workforce by 14%, which is about 700 jobs.
Right, to fund an AI-native operating model.
Which triggers a one-time restructuring charge of $50 to $60 million in Q2.
But swallowing a $60 million charge right now to permanently lower ongoing payroll is a massive long-term margin play.
It really is.
Mm-hmm.
And the most compelling stat, they now securely store 12% of all global crypto assets. 1 out of every $8 of crypto wealth on the planet is in their vaults.
Right. And despite the market dropping in Q1, they gained market share, hitting an all-time high of 8.6% of global crypto trading volume.
That brings us to the catalyst timeline. What events could actually move the needle over the next few months?
Well, first up is the Q2 earnings. Because of this recent headline miss, expectations are heavily lowered across Wall Street.
So it's a much easier bar to clear.
Exactly. Then you have unconfirmed rumors in crypto-native channels about their $2.9 billion acquisition of Deribit.
Right. The speculation is that the integration of Deribit's platform might happen ahead of schedule.
And derivatives volume in traditional finance is vastly larger than spot market buying. So integrating that adds massive institutional trading volume.
There are also whispers of a mega partnership involving an Buy 402 payment protocol, right?
Yeah, with traditional fintech companies, it's unconfirmed, but those are the types of structural catalysts that instantly re-rate a stock's valuation.
Plus the macro tailwinds. Tom Lee laid out a technical thesis that if Bitcoin closes above $76,000 in May, it structurally confirms a new macro bull market.
Right, which obviously reignites their core transaction revenue. And finally, the regulatory landscape.
Ah, the Clarity Act.
Yes. The U.S. Senate is scheduled to mark up the Clarity Act in May 2026. Now, impartially speaking, we aren't endorsing this from a political standpoint.
We're just analyzing the market impact.
Exactly. If it passes, it provides massive regulatory clarity. Establishing clear federal rules strictly benefits heavily capitalized compliance-first models like Coinbase.
While effectively locking out the unregulated offshore entities. Okay, now let's pivot to the chart. If they have all this market share in cash, why does the stock look so bad?
Well, the broader market is driven by short-term headline shock. Pre-earnings, the stock was at $196.25.
It had already dropped 38% over 6 months.
Right, and after the earnings miss, it gapped down another 4.5% to 5%. It tested crucial support at the 60-day moving average.
So the 60-day moving average tracks the average price over the last 60 trading days. Traders use it as a psychological floor.
Yeah, and when it hits that line, analysts talk about a washout bottom.
Where retail investors panic, sell on the bad headlines.
But institutional investors, the ones actually reading the cash flow statements and seeing the $10.2 billion hoard step in and accumulate shares at a discount.
So what does market sentiment look like? Because there seems to be a huge tug-of-war going on.
There really is. Short interest is remarkably high, sitting at 11.5% of the float.
That means 11.5% of available shares are actively borrowed to bet against the company. That is a massive, concentrated short bet.
It is. But the options market is telling an incredibly bullish story. The 50-day call-to-put volume ratio is 2.35.
Wait, meaning for every put option betting it falls, there are over 2 call options betting it rises.
Exactly. It's the highest reading in a year. Options traders are betting on massive upside.
And the structural analyst ratings side with the options market. Rosenblatt has a $240 target. JP Morgan is at $290.
And Benchmark has a $260 target, specifically calling them the everything exchange.
Because they aren't just an exchange. They are the custodian, the prime broker, the staking service, and the payment rail.
Right, they're vertically integrating the entire financial stack. The short sellers are heavily underestimating how much that 44% recurring revenue has decoupled them from Bitcoin's daily price.
Which perfectly sets the stage for a short squeeze. If the fundamental value pushes the stock up, short sellers are forced to buy shares to cover their positions.
Which drives the price even higher. It's an explosive upward feedback loop.
Now, let's talk about the risks. We always need to weigh the bear case.
Definitely. The primary risk is a prolonged crypto winter. If asset prices stay depressed for years, trading volumes remain anemic.
And even with their services revenue, a lack of retail enthusiasm is a heavy drag.
Right. And then there are operational risks. The recent Amazon Web Services outage in North Virginia temporarily took down trading for Coinbase and CME Group.
For a financial custodian, uptime is literally everything. If customers can't trade, it fundamentally damages trust.
It does. But this is where that $10.2 billion cash hoard is an offensive weapon. They have the capital to build multi-cloud redundancies.
Running backup infrastructure on Google Cloud or Microsoft Azure.
Exactly. If AWS goes down, the system shifts the load without the user noticing. Smaller rivals simply cannot afford to build that, so it widens their competitive moat over the long term.
So with everything on the table, what's the final verdict?
The research assigns an 8 out of 10 bullish score to this thesis. The multi-year view here is a transition from a highly cyclical retail spot trading proxy into a diversified, resilient financial infrastructure powerhouse.
It's an amazing corporate survival story.
Yeah.
If they use that massive war chest to build the bulletproof infrastructure Wall Street needs, how do legacy banks react? Do they try to buy them out? Or do they just pay them rent to use the rails? Definitely something to think about.
Absolutely.
Need emergency cash? MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.